Welcome to CoreLogic's update on housing market conditions for November 2017, brought to you by onthehouse.com.au. Welcome to CoreLogic's update on housing market conditions for November 2017. CoreLogic's National Home Value Index held steady in October, confirming a cooling trend in housing market conditions. The easing in growth conditions is being led by a sharp slowdown across the Sydney market, where dwelling values fell for the second month in a row. Both the Combined Capitals Index and the Combined Regional Markets Index returned a flat reading over the month. However, regional dwelling values are down by 0.1% over the most recent rolling quarter, while capital city values were 0.4% higher. The latest figures take the annual growth rate across the combined capital cities down to 7%, the lowest annual growth rate since December 2016, when the first round of macroprudential changes were still working their way through credit policies and interest rates had earlier been lowered by 50 basis points, which subsequently led to a rebound in value growth in early 2017. So why is the capital city trend losing steam? From a geographical perspective, it's mostly due to the Sydney market moving through its cyclical peak in July. Since the CoreLogic index peaked in July of this year, Sydney values are down by 0.6%. However, the reduction comes after dwelling values surged 75% higher since the growth cycle kicked off back in early 2012. The Melbourne housing market, where dwelling values were 58% higher over the cycle to date, has been more resilient to falling prices. Although capital gains remain positive across the Melbourne market, the pace of growth has clearly lost steam, falling from 4.4% on a rolling quarterly basis back in November last year to reach 1.9% over the 3 months ending October 2017. Other markets, where growth conditions have been far less dramatic over the past 5.5 years, are behaving very differently. Generally, the remaining capital cities don't have a high peak to fall from. Conditions across Brisbane and Adelaide are holding reasonably steady, with values still edging higher. Hobart's been on a strong growth trajectory and remains the best performing capital city for capital gains. However, quarterly data also points to a moderate slowing in growth in this city, while conditions across Darwin and to a lesser extent Perth remain subdued. Importantly, the slowdown in housing market conditions is far from uniform, with a great deal of diversity across the regions and the product types. The capital city annual growth trend ranges from 12.7% in Hobart over the past 12 months to a 5.7% fall in Darwin values. Between the housing types, despite a large amount of new unit supply under construction, the past rolling quarter has seen unit values recording a stronger capital gain than houses. Outside of the capital cities, the regional area of New South Wales is showing the strongest growth conditions. Growth has rippled away from Sydney metro area as affordability challenges constrain demand. Buyers are attracted to the lower price points and lifestyle opportunities of the adjacent areas where commuting is still an option. Dwelling values across regional New South Wales are now outperforming Sydney's, with values up 9.7% over the past 12 months. The strong regional growth is being led by Newcastle and the Lake Macquarie region, where values are up by 14.6% over the past 12 months, and the Southern Highlands and Shoalhaven region, which has recorded a 13.6% rise in dwelling values over the year. The combined regional markets of Tasmania recorded the second highest annual rate of capital gain at 5.4%, followed by regional Victoria at 4.4%. Regional areas linked to the resources sector are continuing to show soft growth conditions. However, some of these regions appear to be bottoming out, while in other areas the rate of decline is clearly easing. Regional lifestyle markets are generally gathering some pace as the sea change and the tree change trend picks up and demand for holiday homes improves, particularly in those areas adjacent to the major capital cities. Housing market conditions across Brisbane continue to tick along at a sustainable rate, with dwelling values up 0.2% in October to be 2.7% higher over the year. Dwelling values are rising only slightly faster than inflation and incomes. While this hasn't boosted the wealth of homeowners to anywhere near the same extent as Sydney or Melbourne, housing affordability is far less challenging and rental yields remain substantially higher for investors, averaging a gross yield of 4.2% for houses and 5.2% for units. The outlook for the Brisbane housing market remains positive, with the migration rate to Queensland picking up and jobs growth now tracking well above the national average. A variety of factors are causing housing conditions to slow down. However, the primary dampener is likely to be a new round of macroprudential measures from the prudential regulator APRA. In response, lenders have tightened their servicing tests and they've reduced their appetite for riskier loans, including those on higher loan-to-valuation ratios or higher loan-to-income multiples. Additionally, interest-only borrowers and investors are facing premiums on their mortgage rates, which are likely to act as a disincentive, especially for investors who are generally facing low rental yields on investment properties. The peak rate of growth in dwelling values lines up closely with the peak growth rate for investment lending in late 2016. We saw the housing market respond in a similar fashion through 2015 and the first half of 2016 as investors faced tighter credit conditions following the announcement from APRA that lenders couldn't surpass a 10% speed limit on investment lending. At that time, the pace of capital gains slowed sharply and went negative for a short period of time. Of course, the housing market rebounded in mid-2016 when the APRA-imposed investment credit limits were comprehensively achieved and the cash rate was lowered by 50 basis points. This time around, we aren't expecting a lower cash rate to re-stimulate the market, and it's likely that credit policies will be closely monitored by the prudential regulator to ensure there isn't a material rebound in investment activity. On the positive side, there are several factors that are likely to support a soft landing for the housing market. Financial markets have pushed expectations for a cash rate hike out to early 2019. That implies that mortgage rates aren't likely to rise materially over the foreseeable future. With household debt at record highs, higher mortgage rates would test already stretched household balance sheets. Labour markets have strengthened and population growth is underpinning housing demand, set against the backdrop of limited detached and semi-attached housing supply. Overall, Australia's housing market performance remains as diverse as ever. Historically, sustained growth cycles have generally been followed by a period of negative growth, so a further reduction in dwelling values shouldn't come as a surprise. If you would like to keep a closer eye on the housing markets, check out our CoreLogic website, where we're updating our perspectives on the housing market on a daily basis. www.corelogic.com.au